Chris Campbell is the Kroll Institute Chief Strategist, former Assistant Treasury Secretary for Financial Institutions. Chris, good to have you. Assuming the Federal Reserve does make official this pivot to be a little bit more Spartan when it comes to, attacking this inflationary environment and hiking rates and doing all that sort of thing, what do you think the fallout's going to be?
Look, we certainly anticipate that the Federal Reserve will suggest that they're going to end the tapering program more rapidly, which I think is probably warranted. And I think they'll probably signal rate increases. However, Neil, I think as you know, I worked closely with Chairman Powell, my time at Treasury, and I think that it's a little bit nuanced in the challenges that I think the Federal Reserve has. 2022 is an election year. Chad laid out some of the challenges that are taking place on that. The federal government is poised to spend about $9 trillion this year, and raising interest rates makes it really difficult because you really quickly eclipse all of the discretionary spending the federal government has just to service our national debt. And so what Congress is doing of spending at the rate that they are really hampers the chance and the choices the Federal Reserve has going into next year, trying to find a way to tamp down the runaway inflation that we face.
So what you're saying is the more that they spend, the more the pressure on the Federal Reserve to keep hiking.
I think that I think the Federal Reserve is going to actually have to be very creative because, again, any rate increase, it's interesting. We're in a position where inflation is a regressionary tax, but so is raising interest rates. Revolving lines of credit and mortgages all become more expensive for the average American, and the other issue is I think it's interesting to note is that there's a lot of retail investors now in the market that perhaps weren't in the market earlier, and they've never faced an inflationary period or a period of high interest rates. And so there's a lot of comprehensive challenges the Federal Reserve has to take into account this entire basket of things as they go into trying to find ways of tamping down the inflation. So I believe that probably means they're going to become creative. In 2007, 2008, we didn't know what quantitative easing meant, and I think that perhaps we'll learn some new language from Chairman Powell and others as we go through this process of trying to find a way to tamp down the inflation that we're facing.
Do you think that and I've raised this with other guests, the part of the markets, the bond market's response to this with lower rates is a signal that it sees lower economic activity, that it's not so much higher prices that concern it, or the rates will be a lot higher. It's a slowdown.
Well, you're talking about, effectively stagflation, which we've seen before in our country, which can be really, really dogmatic and very, very pervasive and really challenging. And so, I think that there's, again, I'm going to try to be optimistic here and try to find, and hopefully bet on America and make sure that, I really think that our markets are vibrant and they continue to defy gravity and have for almost 10 years now. And so I think that we're in for still a good times ahead, but I think that the government has to be creative, and certainly the Federal Reserve, although independent, is not completely independent of politics as we enter into next year, an election year. And so, taking in all those things into account, we're going for some interesting times, and certainly hoping that there's not a stagflation period ahead.
All right, I hope you're right about that. Chris Campbell, the former Assistant Treasury Secretary for Financial Institutions, following these developments as we've been